Okay, hello everybody. Today's presentation is about how the climate change affects the business cycle. So, before we move on, I want to clarify what do we mean with the business cycle. The business cycle is the economical output of a country or of a region, um, starting from one recession to the next. Usually in the United States, it's about 5.5 years, but this varies. So a business cycle has four phases. First is the expansion. Now, during the expansion, the inflation grows. What does that mean? That people have already gathered money, they have savings, and they don't mind spending. So if the demand becomes higher, the merchants they push the prices up, and eventually this creates a peak. Now, on the peak is or the moment or the phase on which the production is still on its highest level, but it cannot go higher, which means that people uh, gave the maximum they can afford on specific assets, okay? Or like to buy a house, for example, or a car. Now, after people spend all of their money or they reach the maximum of the capabilities, the industry is going to start producing less. People will be let go, and eventually, this is going to cause a recession, which is where, after the peak, start people losing their jobs, start people cannot afford buying all the goods that they used to buy before, and it pushes basically the price to drop. Maybe not comparing with 5 years ago, but to allow the inflation to start going down, okay? And then we have the trough period, which is basically a recovery phase, if you want me to put it in these terms, is the situation in which the economy is doing bad, people are losing their jobs, but it's on a low, stable level. And then when people will start working again, when people will manage to take advantage of investment opportunities, when people will start working again and saving money again, then we go back to the expansion phase. Then the economy grows again, and then it drops. Now, how do we measure inflation? Okay, now, and the expected inflation or a healthy inflation is around 2%. What does that mean? That the economy is not growing very fast, but is not growing too slow as well. So 2% is the number that the central banks are chasing. This is our target. Now, there are two categories of goods or services that deviate from that 2%, which means that in every inflation, you have energy and fuel and food and groceries that are higher than the 2% or that they're too volatile because of their nature. So if, for example, I don't know, the price of a house will grow by 3%, it is possible that the price of energy and fuels is going to be grow by 5%. That's why we have core CPI and CPI, which one of the measures the inflation or the consumer price index, including energies and foods, and the other one is without. And usually the one without is the more stable one, if you want me to put it in these terms. Now, but why does energy and fuel and food and groceries are so volatile? Well, it comes down to the nature of these instruments. Because the way they are built, a single event or a single decision of a key player in these markets can change drastically the course. So, for example, if the OPEC countries then decide one day to stop producing oil, or if for whatever reason the supply chains interrupt, it's enough overnight to have issues. So if the next inflation data are going to be released in the near future, it's something that it cannot be calculated with. The same goes with food. Food depends on weather. Doesn't matter if it's processed food or fresh food, it goes back to the same raw materials. So if for whatever reason, and bad weather, like nowadays, which It can either have floods or you can have very drought periods. In any case, this will affect the production. So just because of this reason, because of the nature of these categories, because of the nature of a single event or a single transaction or a single decision can affect very, very rapidly these assets, that's why they deviate from the standard inflation rates. Now, how are usually inflation? How is inflation controlled? There are two bodies that they can actually work with it. First of all is the governments. The second of all is the central banks. Now, governments usually do that by either increasing taxes or decreasing taxes, or by cut or invest more money in infrastructure and so on and so forth. Now, this is not so common nowadays, so I'm not going to bother myself with it so much. Central banks, though, it's a different game. So through their monetary policy, central banks have two ways in controlling inflation. The first one is by printing money, which means that there is going to be more supply, so there is going to be a devaluation of the currency. This can be useful, for example, in a case where a country or a region, they want to attract foreigners to invest in their own country. So by devaluating the currency price, it makes it cheaper eventually for people to come and invest in your country. It's more appealing. They try to make the currency, or they devalue the currency to make investing in their own country more appealing. Now, the second way they do it is by raising or lowering the interest rates. Now, the way the financial system works, like the simplistic way, is that the central banks they give loans to the local or private banks. Now, when they do that, they do it with a specific rate. Then, for the local banks to make profit, they need to put a markup, in a sense, and lend money to people in a much higher rate. So, if the central banks, they want to stop people, if the economy is moving too fast, and central banks, they want to stop this, they will raise the interest rates. So they will make it more and more difficult for people to get loans, to buy houses, to buy cars. The second way is in the situation where the economy is low, is not moving forward, is very slow, and they want to boost the economy, they lower the interest rate. So they give cheaper loans to the banks, and then eventually it's more accessible for us to get the loans. So you need to imagine this as, as like driving a car. So either you accelerate or you stop. It's the same logic. Depending on what they want to do, they will apply different measures which will allow them to, basically will allow them to guide the economy. This is what they're aiming for. They are trying to give us expensive money or cheap money based on the current economical conditions, so they can boost the economy or hold the economy back. So whatever we do, the way we behave, either they will try to push to get to the 2% level, or they will try to stop the economy to come down to that 2% level. But 2% is a magic number. So nowadays, though, we have a huge problem. And this does not allow the central banks or the governments to perform as before. That's why, for example, the Fed in the United States, they made their most aggressive increase of interest rates over the past 40 years, and they gave their highest interest rate over the past 40 years, which was, if I'm not mistaken, on 5.5%, and then the European Central Bank was around 4.5%. And why is that? Like back in the days, it was very simple. It was a situation of supply and demand. So that was by 90% the reason why there was inflation, or if you had a recession. People had money, they wanted to spend their money, prices went up. The companies, they wanted to make money, it's normal, so prices went up. At some point, people could not afford to pay more, it had to come down again. Now, the weather or the climate change is also in the game. So what does it mean? It means that if nobody, no central bank, not the governments especially, do not take any actions, then the economic growth is not going to be stable anymore. Why? Because of the climate change, you might have drought periods, as we said before, you might have floods. So in this case, you do not have a sustainability. You don't know what is going to happen. Maybe, for example, I think in Australia, last year they were selling beef for $1, I think, because it was raining so much. The animals, they were eating a lot. They were happy. They reproduced so much that they pushed the prices down. Now, if there was a other way around and there was no production, the prices were going to go up. But the producers and the economy cannot depend on these events. This is not sustainable. So what do we do if we have a drought period for 5 years? So we can all become vegans or die. I mean, it's so simple at the end of the day. So now it's not just a matter of supply and demand. It's also a matter of creating sustainable economies. It's a matter of creating stability. And the way for stability to be created is if we have infrastructure that will allow us to continue business as usual or as close as possible to business as usual, which means that, first of all, we need to be carbon neutral. So we need to find ways to remedy and recover from the damage we cause to the environment, which actually comes down to our own pockets and our own lives. And the second pillar is to find a way to keep that level. So this means that we need to go away from fossil fuels. For example, we need to go away from oil. So we need to invest in renewable energy. But renewable energy, it needs research to reach a level on which everybody can benefit from it. It needs to have infrastructures to be able to operate on a good level. So for example, we have the photovoltaic systems. We need to develop it, okay, come to a specific point where it can serve as a patch, but not as a solution. So the involvement of that was to create batteries that in such a way that every person in their own house can have their own battery. They store their electricity, so no matter what happens, for example, raining 10 days in a row, they will have enough electricity. So they don't need to use the fossil fuels anymore. And of course, the second pillar is the penalties that the government themselves are putting to the producers. For example, European Union, they enforce specific measures of environmental standards, let's say, for European producers, for European factories. Now, what they did is that they said, if you want to import a product into the European Union, you either need to have our own standards. If you don't have our own standards, you are going to pay a penalty on it. So either a factory owner is going to create the same infrastructure, or they're going to pay a penalty. But in either case, the price is going to be paid from the end user, so from all of us. So it's not just a matter of inflation is 2% or 10%. It's a matter of waiting long enough to create this infrastructure, to find the way to the investors that are happening nowadays, after 10, after 20 years, to be able to benefit us also in the terms of quality of life, but also in the terms of creating cheaper energy and actually for everything to become cheaper and more accessible. So as I just mentioned, we cannot expect, it's not realistic to expect that the prices are going to be the same. It's not going to happen. We are not going to come back to the level of prices of 5 or 10 years ago. In order for this to happen, we need to wait 10, 20 years for the money that are now invested in research and infrastructure to actually start paying for themselves and then start taking something back. It's inevitable. There is not any other way to go around. It's the same like any other business. You put money in your business, you wait X period of time, and then you start getting yield. There is no business that you start from the first day to make money. It's the same like trading. It's not rational for someone to think that I start trading today, tomorrow I'm going to be a millionaire. No, you need to break some eggs, lose some money, and then start making money. It's a normal procedure. If you don't learn from your mistakes, you cannot move forward. So there are two aspects in the whole procedure. Either you have the countries that they will be able to come forward and give such initiatives or create some measures that will allow the technology to grow and help with the research and development and the infrastructures. And those are the ones that unfortunately they will not be able to adjust to this time. They will not be able to move things fast enough. This will cause them problems, first of all, in terms of sustainability, which means that they will not be able to have a stable economic output. And the second issue is that it will not make their economies attractive for investors, because I'm not going to invest my money in something that I don't know if it's going to exist after 1 year or 2 or 5 years. This is not how it's going to be. So there are the people that the governments that they will be able to move first. They will manage to increase their quality of life. They will manage to increase the investments in their own countries, and they are going to be more sustainable and have a better quality of life. The ones that they will be left behind, unfortunately, they're going to have much bigger problems in the future. Thank you very much.